Wall Street experienced significant turmoil this week, with the Nasdaq 100 index suffering its largest weekly decline since the COVID-19 pandemic's peak in 2020. This downturn was primarily driven by U.S. President Donald Trump's announcement of sweeping reciprocal tariffs, which intensified investor concerns and triggered a sell-off, particularly affecting technology stocks. The Nasdaq 100, a benchmark heavily weighted with tech companies, saw notable declines in major constituents such as Micron Technology, MU, Microchip Technology, MCHP, and Warner Bros. Discovery, WBD. Despite the broad market sell-off, only 4 stocks in the Nasdaq 100 managed to post gains, underscoring the widespread impact of the tariff news. The tariffs, designed to retaliate against perceived unfair trade practices, have introduced new uncertainties into the market, potentially affecting corporate earnings and global trade dynamics. Investors are now closely watching for further details on the tariffs' scope and duration, as well as potential responses from key trading partners, which could influence market sentiment and economic growth projections in the coming months.
The ongoing trade tensions between the United States and China have escalated, with President Xi Jinping announcing a 34% tariff on all U.S. imports, effective April 10th. This move is a direct retaliation to President Donald Trump's sweeping tariffs on nearly all Chinese products, which will raise levies to at least 54%. These measures are part of a broader strategy by China, which includes export controls on key products and the designation of 11 American companies as unreliable entities. The Chinese Finance Ministry has criticized the U.S. actions as unilateral and not in accordance with international trade rules, emphasizing the importance of protecting China's economic interests. The impact of these developments is significant, with experts predicting a potential decline of up to 2 percentage points in China's GDP. Despite this, Chinese stocks have only seen a slight decline as investors remain optimistic about potential domestic economic stimulus measures from Beijing. Additionally, China has lodged a formal complaint with the World Trade Organization, challenging the U.S. tariffs as violations of WTO rules. This move opens another front in the trade dispute, with bilateral consultations being the initial step in formal dispute resolution. The ongoing trade conflict underscores the fragile nature of U.S.-China economic relations and its potential ramifications on global markets.
J.P. Morgan has increased its forecast for a global recession to 60%, following U.S. President Donald Trump's announcement of extensive new tariffs on imports. These tariffs, ranging from 10% to 50%, have sparked fears of a global trade war, unsettling financial markets. Bruce Kasman, J.P. Morgan's chief economist, described these tariffs as the most significant tax hike on U.S. households and businesses since 1968. He warned that the repercussions could be severe, potentially leading to retaliation, a decline in U.S. business sentiment, and disruptions in supply chains. The U.S. dollar index has reacted negatively, dropping 2.16% in pre-market trading to its lowest point since October, as investors flock to safe haven assets amid heightened uncertainty. The potential for a recession is further underscored by Goldman Sachs, which has adjusted its U.S. recession probability for 2025 from 20% to 35%, citing the new tariffs. Deutsche Bank has also expressed concerns about a possible dollar crisis due to these measures. While J.P. Morgan has not yet altered its economic forecasts, Kasman indicated that the full implementation of these policies could constitute a significant macroeconomic shock. The situation suggests that if the tariffs are maintained, both the U.S. and global economies could face recessionary pressures this year, highlighting the broader implications of the current trade policy shifts on global economic stability.
Treasury Secretary Scott Bessent is reportedly seeking to exit the Trump administration amid turmoil over recently announced tariffs, according to MSNBC's Stephanie Ruhle. Bessent, who joined the administration just 2 months ago, is facing challenges due to the controversial execution of a tariff policy that has been criticized for its simplistic approach to international trade. The policy, which imposes a 10% blanket tariff on all U.S. Imports and reciprocal tariffs on 180 countries has led to a significant downturn in stock futures, with the Dow Jones Industrial Average experiencing its worst day since 2020. Besant, a seasoned hedge fund manager with a net worth of $521 million, is reportedly struggling with the administration's economic strategies, which he has described as maximalist. The tariff announcement has not only disrupted the U.S. stock market, but also strained international relations, particularly with China, which retaliated with a 34% tariff on U.S. imports, further impacting market stability. Besant's potential departure could exacerbate the instability within the Trump administration, highlighting a lack of confidence in its economic policies. The situation underscores the broader market implications of the administration's tariff strategy. Contributing to increased volatility and uncertainty in the global economic landscape.
Tesla is facing a challenging year as CEO Elon Musk's political involvement and an aging product lineup contribute to declining sales. The company reported a 13% drop in quarterly deliveries, marking its first-ever sales decline in 2024, and investors are bracing for further decreases this year. The backlash against Musk's association with U.S. President Donald Trump and far-right European politics has damaged Tesla's brand. With protests and vandalism targeting the company's assets, analysts like Gene Munster from Deepwater Asset Management highlight brand damage as a primary factor in the declining deliveries, with expectations of a 9% drop in 2025 compared to last year's 1.79 million deliveries. Additionally, Tesla faces stiff competition from rivals like BYD in China, exacerbated by an outdated vehicle lineup. Deutsche Bank anticipates a 5% sales decline this year, as Tesla may prioritize delivery volumes over margins, possibly offering more incentives and financial deals. The potential launch of a cheaper Tesla model remains uncertain, further impacting investor confidence. Tesla's stock has reflected these challenges, closing down 5.5% recently, with tariffs on imported battery materials expected to increase vehicle costs by 5 to 10%. Musk's role at the Department of Government Efficiency has also drawn criticism, with analysts like Dan Ives warning of potential permanent brand damage if Musk's political involvement continues.
U.S. President Donald Trump has implemented a broad range of tariffs, signaling potential shifts in global trade dynamics and economic repercussions. The newly imposed 10% baseline tariff affects most U.S. imports, excluding those from Mexico and Canada. These measures are part of Trump's strategy to address trade deficits perceived as being caused by a lack of reciprocity and high value-added taxes in trading relationships. As a result, around 60 trading partners, including the European Union, Japan, and China, are set to face even higher tariffs tailored to each economy by April 9th. Notably, China's response includes a reciprocal 34% tariff on U.S. goods and plans to restrict rare earth exports, crucial for high-tech industries. The financial markets have reacted negatively, with Wall Street experiencing a significant downturn, echoing declines in Asia and Europe. Economists warn that these tariffs could stifle economic growth and exacerbate inflation, while certain sectors like pharmaceuticals and semiconductors have temporary reprieves. Ongoing investigations into industries such as copper and lumber suggest potential future duties. The situation is reminiscent of the Smoot-Hawley Tariff Act of 1930, which had profound global economic impacts. With the average U.S. tariff rate potentially reaching levels not seen since the 1930s, the possibility of a global trade war looms, posing risks of recession and further market volatility.
The financial markets are experiencing a potential crisis of confidence in the U.S. dollar, traditionally viewed as a safe haven currency. This shift follows a significant 1.7% drop in the dollar, marking its largest daily decline since November 2022, after President Donald Trump imposed unprecedented tariffs reminiscent of early 20th century levels. These tariffs have sparked fears of a recession, leading to a corresponding decline in stock markets. Analysts and investors attribute this anomaly to the Trump administration's protectionist policies and the growing U.S. debt, which are perceived as eroding the dollar's global standing. A sustained loss of confidence in the dollar could jeopardize its status as the world's primary reserve currency, affecting global financial stability. The impact of this shift is multifaceted. For U.S. investors, a weakening dollar could result in prolonged higher interest rates, complicating the Federal Reserve's ability to cut rates amid domestic price pressures. Conversely, other central banks face challenges as their currencies strengthen against the dollar, making exports more expensive and hindering economic growth. The euro, for instance, has experienced its best performance against the dollar in over 2 years. Despite these concerns, the dollar remains the dominant reserve currency, backed by the U.S.'s economic strength and deep capital markets. However, investment banks like Deutsche Bank and PIMCO have expressed caution, and market sentiment suggests that the dollar's future is increasingly uncertain, drawing parallels to historical events like the Plaza Accord of the mid-1980s.
The recent implementation of sweeping tariffs by the Trump administration has resulted in significant financial turmoil, erasing over $5 trillion from U.S. stock markets within just 2 days. This drastic market reaction underscores growing fears of a potential recession both domestically and globally. The tariffs, aimed at protecting domestic industries, have instead sparked widespread protests across all 50 states, highlighting public dissent against the administration's economic strategies. Internationally, the ramifications are also becoming evident. Jaguar Land Rover, a major British automotive manufacturer, has announced a pause in shipments to the U.S., citing the adverse effects of the tariffs. This move reflects broader concerns within global supply chains and trade relationships, as companies reassess their strategies in response to heightened trade barriers. The ongoing situation suggests potential long-term impacts on market confidence and economic stability, as businesses and investors navigate the uncertain landscape shaped by these protectionist policies.
Real estate developer Asher Lizzatto has initiated a significant real estate transformation in downtown Denver, acquiring 2 office towers for a mere $3.2 million, a stark contrast to the $112 million valuation they held in 2008. Located at 621 and 633 17th Street, these buildings will undergo a major conversion into residential apartments, with plans for at least 700 units. This project represents one of the largest office-to-residential conversions in the region, with projected development costs ranging from $150 to $200 million. The conversion is part of Lizzatto's broader strategy to repurpose existing commercial real estate to meet residential housing demands, particularly in urban areas facing high office vacancy rates, like Denver, which currently stands at 35%. Lizzatto, who leads the Lizzatto Co., aims to fund this ambitious development through diverse financial sources, including a potential $570 million in funding from the Downtown Denver Authority, which was recently approved by local voters to support such urban revitalization projects. The developer is also navigating complex ground lease agreements as part of the acquisition. The project highlights a growing trend in urban real estate, where developers are repurposing underutilized office spaces into residential units to address housing shortages and adapt to shifting market demands. If successful, this initiative could set a precedent for similar conversions in other cities with high office vacancy rates and housing needs.
California Governor Gavin Newsom has announced a strategic pivot in response to President Donald Trump's imposition of a 10% baseline tariff on all imports, which has provoked global retaliatory measures, including a significant 34% counter tariff from China. This move by Trump has led Newsom to seek direct trade partnerships with international allies to shield California's economy, which is notably the 5th largest in the world, from the adverse effects of the federal trade agenda. Newsom's administration aims to ensure California-made products are exempt from retaliatory tariffs, emphasizing the state's commitment to open and fair trade practices. The economic implications for California are substantial, given its $675 billion in two-way trade and significant sectors such as agriculture, high-tech industries, and manufacturing, which collectively support over 1.1 million jobs. The new tariffs threaten to disrupt supply chains and increase costs for essential goods, such as steel and aluminum, crucial for industries and rebuilding efforts post-wildfire. Newsom's proactive approach includes identifying new international partnerships to protect these industries and maintain stability amid federal trade disruptions. This strategy underscores California's distinct economic path and its dedication to sustaining its global trade relationships despite the broader national trade policies.